various deal points. And we'll also do a bit of comparison to the US as we do that. I just think it's a preliminary matter, if it's okay with you. We'd prefer that you jump in and participate in the discussion. And we will discuss it amongst ourselves, but please don't anyone hesitate to jump in. We'd just much rather have it be sort of an interactive discussion with you, especially given the size of this group. So it gives us an opportunity to do that. Just very briefly, I will introduce the team here. My name is John Fitzpatrick. I'm a senior partner in the Istanbul office. I work internationally. I'm an M&A lawyer by trade, US and EU trained, qualified in various jurisdictions. But my sort of job is to work on transactions, particularly M&A deals on a cross-border basis, particularly in emerging markets. Annelle, who's sitting next to me, is based in London. She's very much an international lawyer. All of her practice is focused on cross-border deals in Europe and beyond, but particularly in emerging Europe and CIS at the least. Ava Tamashi as well, based in London, works cross-border, qualified in New York and the UK, lived in New York, practiced in New York. And she too works cross-border on deals, again, mainly in emerging Europe, Turkey, CIS and beyond, but that tends to be our focus. Last on the end of the table is Alişan Babalıoğlu, who is our senior partner in Turkey, and he too, although Turkish focused, spent many years practicing in the UK and did his LLM in the US. So we're kind of a group of people that is transatlantic and cross-border. And so I think for this presentation, it should be quite interesting, hopefully. I'll move on a little bit about CMS, and I'll do this very quickly. In short, we're a big international law firm. We have a lot of lawyers in a lot of places. I think that's one of the things that is different about us, is we tend to be quite deep wherever we are, as opposed to being, 100 lawyers in Germany. We're the largest law firm in Germany. We try to be strong in whatever jurisdiction we're in, one of the leading firms. One of our unique features is the scope and depth of our emerging Europe, Turkey, Russia, CIS practice, if you will. As you can see, we have 550 lawyers in the region. That's the size of a good-sized law firm. In each country, we're one of the leading firms. So in the follow-on presentation, that's quite relevant where we focus on CE. I think what's very relevant, the reason I bring this up is not simply to plug our firm, but also to give you an idea of where this study comes from. We're one of the top firms in many jurisdictions, including France, Europe, UK, CE, in terms of our rankings on M&A. So we do a lot of deals. Now, we don't necessarily do the biggest deals, and if you look at the rankings sometimes of law firms, you'll see a firm that has a massive number, but they've done one or two deals. It's just a big deal. Whereas for us, we do a lot of deals. And I'm going to skip this slide, it's just on the CE. That brings us to the study very quickly. What's interesting, I think you all have a copy of the study. We're not going to go through every point in the study, but we've been doing it for about 8 years. It's very similar to the ADA study that has been done for a long time. And so that's where we get our US and EU comparison, European comparison. But we've analyzed a lot of transactions. It's a lot of work. It's a relatively unique piece of information. And to be very honest, I've used it on our deals many times. You get in negotiation and you're just stuck. What should the liability be? And you have no real basis for arguing it. Well, sometimes I'll pull out the study and I'll say, hey, this is what generally people do in Europe. And I think it can help you break through, because there are differences between the US and European practice, if you will. And sometimes you can bridge those by looking at what is market practice. And I think that's kind of the whole purpose of this this study. In terms of M&A, I'm not going to get into talking about too much about the details of what's going on in the market. You know, some places it's down, other places it's up, but you can see from the charts if you look through, there are various trends, but generally the trend is up. I think one of the probably the only interesting slide here is the one on the bottom left, or the left-hand side here, where you see a very large spike in the number of U.S. acquisitions in Europe. So, as you can see on the trending line on the bottom left, the blue line shows U.S. buyers coming to Europe. So very relevant for our group, I think. And now we shift into the substance, and very quickly we tried to select 5 areas that we thought, 5 or 6 areas that we thought were particularly interesting from a U.S. and EU perspective, so you could get a cross section. And I think I'll transfer over to Ella right now, and she'll talk a bit about purchase price adjustment and lockbox mechanism, SPAs.
Thanks, John. I think probably as an opening remark, which doesn't just apply to the purchase price terms, but to deal terms overall, is that Europe is still very much a seller market, and quite a heated seller market, in fact, quite competitive these days, which may not be the case in the US, which may still be sort of buyer-friendly, or relatively buyer-friendly. And that I think translated over the past couple of years and certainly over the past year, in buyers having to pay a lot more to get their deal, and also having to spend a lot more time negotiating pricing provisions. And that was both in terms of purchase price adjustments, so completion accounts-based mechanisms, as well as lockbox, where there wasn't a purchase price adjustment. So while there was an increase last year in the use of purchase price adjustments in Europe, it might be interesting for this group to know that it's still less than half of the deals in Europe that have a purchase price adjustment, which I think is a very notable difference to the US, where we'll have a slide on this, but essentially about 86% of deals in the US, the vast majority of deals, have a purchase price adjustment. Also interestingly, but I don't think surprisingly, where there wasn't a purchase price adjustment, there was an increase in the use of a lockbox mechanism. So essentially fixing the purchase price based on a historic balance sheet or account date.
Query with it just very quickly. Does everybody understand the distinction between lockbox and purchase price adjustment? Because if they don't, we can summarize briefly. I mean, I did. You know, it's not a very typical American thing. It took me for a while to get used to the lockbox mechanism. So, do you want a brief summary?
Please.
Okay. I think it's helpful because
Sure.
we don't have that many more experience.
So as I said, in a lockbox mechanism, the purchase price is set by reference to a lockbox date, which is a historic date, be it the year-end, the date of the year-end accounts, or half-yearly accounts, or sometimes, bespoke balance sheet prepared for the transaction, whatever the parties agree. And that essentially means that there will be no adjustment between that historic date and the completion accounts date. The purchase price is locked in time, and the risk essentially and reward, if you will, of the transaction is fixed by reference to that historic date. And there are a bunch of advantages, obviously, with that, in that it gives sellers a certainty that whatever they get on completion is what they go home with, which for private equity buyers, for example, is quite paramount, because they want certainty in terms of what they can return to their investment. And it's actually a trend that was, to a large extent, started by private equity transactions in Europe. Also, it can be more cost effective in terms of avoiding disputes post completion in terms of purchase price adjustments and so on. The flip side of that is obviously that buyers take the risk of balance sheet shifts between that historic date and completion. And where there's a huge gap between signing and completion, or between that historic date and completion, that might not be very palatable for buyers.
And I think, you know, very simply, what we're doing is allocating the risk between signing and closing. And so, lockbox is fixed at signing. In an accounts mechanism, you have an adjustment at closing. And so, one of the other advantages, Elle will probably get to this, but I've found in Europe that in many jurisdictions, particularly emerging markets, it's difficult to agree the accounts. You know, you have different accounting standards, local, GAAP, IFRS. You get into this strange discussion when people don't understand the schedule, the detailed schedule you need to do a proper accounts mechanism. So we often find that it's not simply just PE versus non-PE deals, but also depending on how people are able to understand. Sometimes lockbox can be simpler. Sorry.
Would you have an escalator, de-escalator clause into that? Because if there's so much of a shift, you're going to say, okay, move 50 points, call it 50 points. We actually have to put more money into the deal, or if it's gone down, then we subtract from the lockbox price you put on the balance sheet, or whatever, however you set that.
You certainly can do that. You can carve up the lockbox. I had a ridiculous
Because
discussion.
it could go off, and with many political, well, that's going on right now in the economy, there's a lot of volatility, so you want to lock down that volatility as much as possible.
Well, you know, you can have, so what you're saying very simply is you have a sort of a modified lockbox.
Yeah.
You basically break out into some kind of adjustment, and you can cut that many ways. But I think that's problematic in my view, in the sense that you either make a decision, which is what you want lockbox or not. But, go ahead.
I think they're a lot less common, these hybrid structures in Europe, but I've seen a few, and I think what it comes down to is a lockbox with a working capital adjustment. So you've got the lockbox, but then you do have the working capital element, which is essentially, you know, cash in the business. And I think the important bit about the lockbox, as you know, some of you who have used it, will know, is these no leakage covenants. So essentially, when you set the purchase price historically, you want to make sure that there will be no leakage in and out of the companies to shareholders or the stakeholders, employees, and so on. So going back to our study, what we've discovered again is that where there was a purchase price adjustment, there was quite a notable increase in the use of lockbox. And again, it may have to do with more private equity deals out there. Last year, to be honest, M&A, global M&A was up, definitely, but private equity was certainly on the rise across the board, even in CE, as we'll talk about later. The next slide is essentially looking at, how deal size influences these choices. And the bottom line is that, you know, the larger the deal, the more prominent, the more likely the use of a purchase price adjustment or lockbox. And as I mentioned at the beginning, there's a very notable difference with US practice. And the other interesting point, again, going back to working capital adjustments, is that even there, well, I think over 80% of deals in the US, large majority of deals in the US that have a purchase price adjustment also have a working capital adjustment. We're talking about only about 40% of deals with a purchase price adjustment that use working capital adjustment, so the two don't always go together.
Please come. You can sit it along on the inside as well. Sorry. Yeah, so moving on, just conscious of time, and I'm going to do earnouts very quickly. I think, you know, there's more usage of earnouts US versus Europe. And, you know, in my view, the earnout always boils down to, you know, how do you calculate it? And you can see on the slide, here, in the bottom left-hand corner, turnover and EBITDA are critical. And I think one of the things about found is it's very critical to get that right, because that determines behavior. Having lived an earnout myself, been on the receiving side of an earnout, I mean, it really determined that behavior. And you'll see that sellers do that. So you got to be very careful. You know, if you put a turnover mechanism, that's going to incentivize revenue, obviously. You put an EBITDA mechanism, it's EBITDA, it's going to incentivize profit. You know, so you create these strange behaviors with it, and you can construct any kind of way to do it. As you can see, the other is quite a big category. But I think smart thing to do is think about that. What behavior do you want to incentivize when you're doing an earnout?
I think it's fair to mention, John, that in Europe, we experienced that it was most common in the TMC sector.
Yeah, a lot of earnout schemes.
Especially German-speaking countries.
I think another important salient variable on the earnouts is you tend to see them with is uncertainty. Makes sense, right? So you're not going to pay everything up front. You wait to see how the business performs. So you're going to see, and you also in emerging markets, you tend to see a push for earnouts as opposed to in the more mature markets where you kind of have certainty as to revenue.
Sorry, just me, I'm just curious how you see these schools. You always have 4 or 5 of them, and half of them are there being some sort of towards the end.
We agree. I mean, that's why I say it's very important because, often, especially if we have the founders still in control and, you basically have a conflict between new buyer and the sellers and they're still involved, we really need to think about, is it worth, because M&A is not just about that, price, it's about the integration. And the earnouts can become an issue for integration, yes.
How do you work at social programs across Europe if you're doing an earnout? Because that can be very volatile again too.
Social programs.
So you're going to be assisting employees, downsize.
Well, I think
It's very restrictive in Europe.
yes, but that the business, if the business is a European business, it has that issue. And so if you're saying if the buyer wants to downsize and the seller doesn't.
Yeah.
It's actually, I think it's tied to your question as well. The disputes for earnout are actually control issues. So, once the seller hands over the company, he remains in management, but loses certain elements of control, which leads to the dispute. The argument is, I would not manage this company this way. And I think the solution to that is to have, to the extent possible, more detailed provision saying what the new owner can do or cannot do and how the company should be managed. And I think downsizing the employee base is a good example of that. In a good agreement, we have a specific clause about that and what other things the new owners can do, because otherwise the beneficiary of the earnout has no control over the mechanism.
Yeah.
And the other interesting thing is that we don't have it on our slides, but we do have it in our study. We also do a breakdown in terms of the length of the earnout. And the most popular one tends to be either between 6 and 12 months, or the very, very maximum 12 months to 24 months. So you can see where, if they do have downsizing plans, if you have a 6 to 12 months earnout, you can time it so that it doesn't affect your earnout.
I think it's absolutely critical, as Alajan is saying, is to spend the time on the earnout. Don't just do a simple clause that gets you in your disputes. You really got to think about things like how is the business going to be run, how it's going to be allocated between the people, and the long-term integration plan. So moving on earnout, so we get to the other subjects. I think we're going to talk a bit about liability caps and baskets and whatnot.
Yeah.
And Ava will take that point, and I think it's, there's quite a drastic difference between Europe and the US on this point.
Thank you, John. Yeah, so as John said, this is an area where we see a fairly striking difference between the European and the US practice. and that is the sort of seller's liability limitation regimes in general, in particular baskets and overall liability caps. The baskets are generally, some sort of basket provisions are generally the norm in the US. We understand that in 98% of the cases, parties agreed to last year to some kind of basket provisions. That said, it's a continuing trend in Europe as well. We've seen a steady increase of basket provisions in the M&A deals that we advised on. In 3/4 of the cases last year, we saw some kind of basket provisions agreed by the parties. So, which is quite a sizable increase to the past 5-year average, which was 62%. So it seems that the popularity of basket in Europe is catching up with its US frequency. But there is an important difference between the approach that the US and the European counterparts use. The basket thresholds are usually lower in the US, but as the next slide shows and illustrates, once that threshold is achieved and once that threshold is exceeded, only the excess is really covered by the buyer, as opposed to the European practice, where the basket thresholds are higher, but once the threshold is exceeded, buyer can recover the full amount of the claim.
Yeah, and if you move on, you see the EU-US comparison, it's actually quite different.
Yeah. So the next slide shows the size that I mentioned, that the size is definitely higher in the US. Sorry, the size is definitely lower in the US. But then the flip side for the buyer is that they can
cover
the excess, but only the excess. But in Europe, it's higher, but then the first dollar basis once the basket threshold is exceeded.
I think it's just a general comment too, because when you're doing an EU-US deal, it's important to know that there are differences. And when I first I remember having a violent discussion with one of my partners about representations and warranties and indemnities and what you get, the UK practice versus the EU. It's important not to get stuck on those issues, understand the difference, move on with it. You can have a lot of, and really it's all negotiable in an M&A deal, so one or the other will work.
And just going back, as I think the first slide showed, it's not as the norm in Europe still, having some kind of basket provisions than in the US, whereas 98% of the cases have some kind of basket. But within Europe, the most frequently used transactions we see in the German-speaking countries, in France and in the UK. And I think it's fair to say that we see it more often than not across the Central East European jurisdictions as well. And the size of the overall liability caps in the US, the trend is usually relatively low overall liability cap. Usually we see less than 25% of the purchase price.
I mean, just look at over 50%, zero on the US side, right?
Yeah.
So 3%. And so we will often see in emerging markets, you can see that 26% is capped at the purchase price in Europe, which is huge.
Yeah.
And I think that stems a lot from, in Russia, we'll get 100%, or Romania, or wherever. We will push to get a high cap on liability.
In the US,
it's very regional too in Europe.
Sorry, overall, I think in the US, in 92% of the cases, we noted liability cap, overall liability cap being less than 25% of the purchase price. So, as opposed to the European landscape, which is way more diverse, and we see higher overall liability caps, either being between 25%, 50% of purchase price, or very often the whole purchase price, the whole transaction consideration. I think it very often depends on the deal itself. For example, in the UK, very often sellers only give the fundamental guarantee. So in that case, it's only fair to expect totally unlimited liability from the sellers. As opposed to the other side of the spectrum, where you have fairly complicated, long warranties, various structures of different types, and even the limitation periods are different, then you have a way more diverse and multi-tiered liability structure on the overall liability cap as well.
Deal size is relevant as well. Moving on to the next slide.
Yeah. Last year, we started to analyze the various M&A deal features by the deal size, and we set up 3 categories, as the next slide shows. And the rule of thumb that we sort of crystallized was that the higher the deal value, the lower the liability cap overall. If you look at the slide, that shows that in case of deals where the deal size is over 100 million euro, in well over half of the cases, you've got less than 25% of the purchase price as an overall liability cap. It's a very striking feature that came out of the study.
And I think just globally what these tools are useful for on deals is, I find that it's a waste of time for parties to fight over issues if there is some kind of practice. And if you're a bit nuanced about it, so for example, if it's a pure UK deal and our study breaks it down by region, there's no point fighting about which is largely the practice, because that practice is driven by factual reality. Title to real estate, pretty well established in the UK, not the case in Romania. Okay? So there's a reason why there's a big difference and why we have these differences in the various countries. And so the study helps to be able to bridge that gap and say, okay, yes, I know it's, you have a UK lawyer on the other side of the deal is in Bulgaria, and he says, I want a 25% liability cap. Well, you say, I know that's typical in the UK, but this is Bulgaria. Or vice versa. You have a Bulgarian lawyer involved in the deal in the UK. You need to look at what the practice is, and usually the practice is driven by reality on the ground. It's a substantive issue for them.
Can I ask you, is it the seller that drives this? So on a European basis? So the seller would drive the liability?
In terms of liability, limitations of liability, it is very much at the seller point, but it comes down to negotiation and strength of the parties. But in Europe, it tends to be a seller-dominant discussion. And if you're talking about a competitive, an auction type of process, then it's almost entirely down to the seller.
And we still continue to see some privatization, especially coming out of the southeastern European region. And Ella had a couple of privatization deals as well. I did a few over the past few years, and we see that governments tend to be very strict, basically, with limitation provisions. So we see really seller-friendly provisions coming out of the sell-side SPAs.
Sorry, go ahead.
On the government point then, in terms of the length of the warranties that are given, because obviously it's those that also potentially determine the liability cap, they are presumably less or very time limited.
They are less, but interestingly, they're more than they used to be. So if you look at the first wave of privatizations, early 90s to 2000, there were almost no commercial warranties. The state was just giving title warranties, very, very basic. Nowadays, the focus is much more on price when it comes to privatizations. They want to max out what they can get, and then the commercial discussion becomes a lot more commercial, really. So you see an increasing number of commercial warranties, a lot less still than in private seller type transactions, but you do see them. And then limitations of liability, as I said, tend to be stricter. So shorter liability, time limits, smaller liability caps, and so on. But interestingly, on one of the transactions I've been involved in, we have managed to get indemnities out of the state, which was unheard of. So I think that the practice is very much shifting towards a much more commercial, private seller type of discussion.
It also, on the privatization side, depends for your buyer. It's like, for example, if you have an IFI in your deal, and we're going to talk about that a bit later, they often get what they want from the state. So I often see private parties partnering with an IFI if you're in a public deal, because you can get, they carry a greater leverage. There's usually a piece in that. And you kind of got to think of a privatization as it's almost like a really strong auction. So you're going to get less protection when you buy. Sorry.
Maybe you've just touched upon the point, but I'm just looking at various other aspects of divisional risk between the parties. I've heard that you say it's very much a seller's market, generally both sides of the Atlantic, that buyers are paying a lot more than they have in the past. My understanding is that since the financial uncertainty since 2007, buyers have been more risk averse, and they have done more due diligence, and they are looking for more in terms of the warranties. Is that still your experience?
I think that's very true. You can track this through the study, because if you compare 2010, our study goes 2010 to 2014, but if you actually look back to 2010, a very different landscape. So we're migrating back towards a more seller market. But for sure, not so long ago, a couple of years ago, definitely buyers got a lot more.
Yeah, the flip side of that, if you think about it, is that because of the uncertainty in certain markets, because of the crisis, there seems to be less good assets out there and much more competition for them, which shifts the balance back to the sellers. But you're right, we've seen an increase in the use of vendor due diligence, for example, for that reason. Because buyers expect to have it, because buyers expect to have diligence the asset very well and so on.
But in general, I think in general, in 2010, 2011, 2012, there was much more noticeable immediate impact of the financial crisis, and parties were dealing with the aftermath of the crisis. So when we talk about sellers market, we are talking about the past. The positive flip side for the sellers of the past 2-3 years, not talking about 2012, 2011.
Can I ask you another question in relation to the locked box, which is becoming more popular? Are you seeing more buyers with a locked box, facing a locked box? Are they spending more time negotiating some involvement, or not necessarily control, between contract and completion?
Absolutely.
Yeah.
I mean, it's the quid pro quo. If you're going to get it, you can get good governance and good control of that interim period.
But we also see variations in the use of lockbox by industry sectors, because lockbox tend to be less commonly used in regulated industries, like in the financial services sector or in the energy, where regulatory approvals are needed, and obviously the gap in time period between completion and exchange is very long, as opposed to consumer products, TMC, where even if there is a gap, the gap tends to be a bit shorter, then it's much more palatable to the buyer to agree to a lockbox regime.
To mitigate the risk in the interim period, you really need very strong covenants, restrictive covenants, limiting the operational needs of the company, and sometimes for some types of companies it's just not feasible to have those type of control, because the companies.
Yeah, and then of course there's the antitrust issues as well.
Get too much control. We're going to touch very briefly on warranty insurance and break for a few minutes. I think, Adrian, if you could do a quick one on warranty insurance. It's not very common in the U.S. or
absolutely. Well, WI insurance policies have taken off in Europe, and over the years have become fairly common. But we understand that they are sort of getting more popular in the US as well. They are rooted in the same industry on both sides of the pond, the private equity industry, where obviously the private equity funds want to return the sale proceeds to their investors without minimal intervention from the buyer, so minimum very limited recourse. So WI insurance policies are a very important tool for risk allocation for sellers and buyers as well. Makes the negotiation way more formidable and smooth, because it gives a very important protection to the buyer and limits the liability of the seller to a really large extent. Again, as I mentioned earlier on, it was maybe on the previous slide, that we try to point out various features by reference to the deal sizes, and it seems that it's a very remarkable, very notable feature that in larger size deals, the use of the WI insurance policies are very more common for obvious reasons. And predominantly in Europe, the WI insurance policies are taken out by the buyers. So it's very rare that the sellers will pick up the deal at the end of the day. Very rare. They are very common, obviously, in a competitive auction process scenario, because it makes the whole process way more palatable and way more flawless. In most of the deals I've closed lately, private equity deals, we started the process with the WI insurance policies deal in the process. The sell side started to, the sellers reached out to the insurance companies. Later on, obviously, the buyers to go through the process, but it's very much a very independent part of the whole process.
You can also mix a liability regime with a warranty and indemnity insurance regime. I'm doing that on a deal right now because you have fundamental differences between the parties and the issue. So you have sort of a cap that follows the standard regime, and over that threshold, the warranty and indemnity insurance kicks in, which gets the insurer more comfortable and also then gets the buyer on the hook, which you want, which the insurer wants. The insurer wants to make sure that, you know, somebody's has skin in the game with respect to the warranties. So you can, sorry.
John, I also find that it can help cut through some of the issues that you were talking about before. So, for example, where there's a disparity between what the buyer expects in terms of capital and liability versus what the seller's prepared to give. I work in the industry, in the warranty and indemnity insurance industry, and we found certainly in the UK that it can actually cut through those negotiations by saying, okay, well, my expectation in my jurisdiction is a 50% cap, but what the seller might be prepared to give is a 10% cap. By ensuring it on the buy side, they can actually get to that 50% cap, in spite of the fact that the SBA might say it's a 25% cap or 5%.
Absolutely. The deal I'm on right now, you have one private equity seller, a hostile second shareholder, and the selling founders. And so classic case where, you know, these exiting shareholders and the private equity don't want to give anything. Part of them are willing to commit. So warranty insurance is playing a big, really saving the deal. Because otherwise, you know, the buyer just wouldn't do the deal.
Yes, absolutely. I mean, this slide in particular shows that what are the advantages in a negotiation and in a deal context of the WI insurance policy. CMS advises on various M&A deals, not only the seller or the buy side, but we regularly advise the insurance companies as well. They buy large 100 deals per year, just on the insurance side. So we have a good understanding of the expectation of the insurance companies as well. It's a good experience because we can translate that knowledge and know-how to the sort of buy side or sell side representation as well. So this slide shows the various features and attractive features for the parties. For example, as you said, the liability cap can be very low for the seller, but the WI insurance policy picks up the rest. So the buyer is happy, the seller is happy, everybody's happy, it's a deal.
Maybe we should move on to the MAC clause.
Yeah.
And maybe I'll do a little introduction and then let Elijah take off with that. But, I mean, I was on a deal not so long ago where, you know, the MAC clause became a huge issue. And I'm both European and American, and the seller was saying he's too American, he's pushing too hard on the MAC clause. But I knew there was a long period between signing and closing with a lot of risk. And we fought hard on that clause. And in the end, there was a threshold, a high threshold. We're talking multiple millions. And the threshold was met, and the impact for the buyer was in the tens of millions in savings. And so you can see there's a drastic difference between US practice and European practice. And this is a hard fight in Europe. But I think you really have to look at the deal and decide whether you want to have that fight. And if you do, it's not unimportant. So with that introduction, I'll flip over to Elijah.
Well, thanks, John. Not much left for me to say.
No.
I mean, the back clauses are, as John mentioned, much more common in US practice as opposed to the European practice. I think in the top half of the slide, you actually see that it's pretty much static, although the order is wrong. You see that MAC clause between 2010 and 14, they were on about 15% of the deals. In 15, it's about the same. They're on 16% of the deals. The more interesting fact is that the larger the deal size, the more common is the material adverse change rules. And I think that makes sense because in larger deals, you have usually longer return periods between signing and closing, hence the risk is enhanced. And also, you basically, there is more at risk in terms of monetary terms. So deals lower than 25 million, you see that only 12% MAC clause as opposed to 30% for deals larger than 100 million. In the next slide, you see the US Europe comparison. As mentioned, there's a huge difference here. You see on 91% of the deals in the US, you have MAC clauses as opposed to 16% in Europe. And I think this is more of a cultural issue than anything else, and how deals historically have been negotiated in different jurisdictions. But also, you could say also that the US is relatively a buyer-friendly market, whereas Europe is more of a seller's market. So, interesting fact is the UK specifically, you don't see this here, but the UK, the rate is around 6%. So even compared to Europe, UK is a different tax rate, much lower than the usual. Whereas in Europe and Central Europe, it's around 20%.
It also relates to, you know, the risk of the market. So it's time, you know, what is the time, the distance between signing and closing, and also market risk. And Elijah was on a deal last year, and I was shocked at how much the MAC enforced on that deal. Which is relatively rare. However, it's extremely important when it happens.
It's not just the number of MAC clauses or how much of them you have, but it's also the substance of the MAC clause, which can be tailored to the jurisdiction. Last year, I will talk about it more on the next presentation, but last year we had a period where in Turkey we had 2 elections, and there was an interim period where basically nobody wanted to do anything in the market. But on the ongoing deals, the buyers negotiated to have a clause put in there almost as a CP to have a permanent government elected in order to complete the deal, which in reverse side was also applied as a MAC clause, which is interesting. So you can have MAC clauses address certain specific jurisdictional issues as well.
Yeah, and I think like all these other clauses, if they're relevant to your deal, it's worth spending time on.
I think all of these slides we've shown you are just, I'm not going to talk about this one specifically, but just a snapshot of the study that was done based on almost 2,800 deals. And it gives you, I think it gives you 2 main things. One is to understand the cultural differences and where, your counterparty, especially cross-border deals, what that means from the marketing perspective of the market they're coming from. And secondly, it's an objective negotiation tool as well. I've used it in one of my recent deals as well. There's also discussion between parties about what market standard is, because it's completely subjective. And people argue about what market standard is. The other side's lawyer was telling me that you and I must be operating in different markets because what you're arguing is market standard is not market standard. And this is based on objective data, and you can use it to, whether you argue what the liability cap should be, at least in terms of the range amongst market standard.
Problem is sometimes people pull it out on us from our own deal. But it doesn't matter, because in the end you want to come to a deal. And so if you have something to use that's fair, it gives you some market practice. But I think for this segment of the presentation we'll wind down. I don't know if anybody had any other questions on this part, and maybe we'll take a break for 5 minutes or something.
Maybe even offline, it would really be interesting to see if this resonates at all with your experience. So maybe a little break, we can get through these.
Okay, so maybe we'll take a 5-10 minute break. I think that, I'm not really going to do an introduction as I did the last time, but this looks like a lot of people here, other than to introduce our new panelists. And I would say one thing that I already raised in the initial introduction. This is a CE emerging market panel, and this is very much part of our DNA at CMS. We do a lot of emerging market deals, in Central and Eastern Europe. And our panel does as well. So I think we have 2 people joining. Christopher Garner is the senior counsel at FMO, which I love their tagline, which is the entrepreneurial development bank. I don't know if that means anything, but I think it's quite unusual. FMO is very active in emerging markets. In addition to being a senior counsel, and both of you have very similar backgrounds, at FMO, Chris's former Slaughter and Manny White case, etc., has a full understanding of how we work as outside counsel, and has done a huge amount of deals, both debt and equity, across the region. And so moving over to James. James is a senior counsel at the EBRD. Again, like Chris, has been outside counsel at Hogan Lovells for, I think, about 8 years, so has lots of experience on both sides of the equation. And again, like Chris, has done lots of deals. I think I saw 150 plus debt and equity deals in emerging markets in Eastern Europe. So I think we have a good cross-section of the people involved. And the IFIs, or the development banks, are oftentimes in emerging markets one of, if not the largest investor in the country. So they almost are market makers oftentimes in the way deals get done. With that introduction, I think we'll start off into the panel. First, I was going to talk to Anela about CEE generally, and then Alajan will talk a little bit specifically about Turkey, because it's a bit of a different market in certain respects. But there's been a trend, somewhat slowing, but increasing in certain markets. And I guess the question is, what do you think about that? What would you attribute it to? And I guess for the panel and for the audience, just jump in if you have views.
I think you're right in that CE saw a bit of a reverse trend, if you will, to the rest of Europe, and actually to the rest of the world. If you look at what global M&A activity was last year, I think it was the highest in terms of both value and volume since 2007. So it was a tremendous year for M&A worldwide. CE did see a decrease in, CE as a whole did see a decrease in M&A activity. And I don't think that's surprising if you look at the dynamics in the region with it had to go through over the past couple of years. You've got recent changes in government in a number of countries. You've got populist governments in Hungary now, Poland, governments that are a lot less receptive to foreign investment. You've got the unrest and the political tensions in Turkey. You've got the Ukraine crisis, and linked to that you've got sanctions imposed on Russia, and the fact that actually with the oil prices going down, Russia is facing quite a bit of a economic crisis in itself. You've got the Greek debt crisis last year, which was perhaps more impactful on CE because of the proximity to Greece, because of the trade links to Greece. And you've got Brexit this year, which, as you probably all know, is affecting the whole of Europe. What I think is more surprising and quite encouraging is that, as John mentioned, some of the countries ventured quite well last year, and we saw an increase in both deal volume and deal value in terms of M&A activity. Poland, before the change in government, Hungary, actually, despite the change in government, certain countries in former Yugoslavia, such as Serbia, Bosnia and Herzegovina, they both had a very good year last year. And the other encouraging fact is that private equity investment in the region went up by 16%, which again is a counter trend to the overall CE trend. And we've seen quite a few of the large buyout houses, both US and European, take an interest in the region, some of them for the first time actually. So we saw TPG, we saw KKR over the past 2 years make their first investment in the region. We saw CVC, we saw Blackstone, Bridgepoint, obviously the veterans such as Majorca Partners and Advent, still very active in the region. And what they're attracted to, quite interestingly, are these large pan-CE assets, so anything that's of large scale or scalable enough. Both TPG and Blackstone acquired pan-CE logistics and real estate portfolios. Advent sold their pan-CE pet food business last year, and they saw huge competition, including from some really large US funds. KKR, as I'm sure you know, 2 years ago acquired a Serbian telecoms operator, SPB Telemat, with operations across former Yugoslavia, and they're now on a quite ambitious consolidation buy and build spree. So I think the takeaway is that the region lends itself quite well to consolidation, to growth strategies, to creating these very large scale or scalable businesses. The other interesting thing we've seen is an increase in investment into CEE from outside of Europe. And interestingly, the most active investors, at least on the private equity side, were from the US, which is probably not surprising given the strength of the dollar, given that increasingly investors in the US, I believe, are looking outside their domestic markets for good assets. And we've also seen an increase in interest from Chinese and South Korean investors.
One thing I neglected to mention is that Ella is private equity specialist.
Yes, which is why I say the word private equity quite a lot.
You're talking about private equity side,
But I do think
which
in
is
the
important to
market,
understand because they're big players in these regions. That the entire legal workflow moves out there. I think that's shifting. More local responsibility, definitely. And secondly, I think the market is shifting more to a role of trusted counsel, to add to what Ella was saying. I think that's becoming also an expectation from the clients as well. Not only to advise on the technicalities, but to have a more commercial approach, more broader approach, risk-based approach, and advise on other aspects of the deal. In Turkey specifically, I mentioned the growth in the economy. Well, roughly the last 10 years or so, we had north of 3% all the time. And
in some years close to 7-8%. So that brings a growth of the economy in general. I think the legal market on top of that is growing exponentially because of cultural and management changes in the country. Chris, you mentioned family businesses. Turkey, I would say, is almost more than 90% family-owned businesses. And that's made a big impact on the way of doing business in Turkey. Typically, in these companies, you have one legal counsel who actually would not do any transaction work or even contract work, would only follow up the unpaid debts of the company. And the culture of using lawyers is relatively new. And the big impact is in these family businesses, you now have second or even now third generation, well-educated, who understand the value of lawyers, and also professional managers who in turn understand the value of lawyers. So that brings growth.
Definitely like that.
Yeah, yeah, we like that. And not only use of external lawyers, but you now have in-house departments, more strong departments. So the market is shifting.
I think conscious of time, what I'm probably going to do is I'm just going to, maybe I'll summarize the outbound and inbound investment issue. You're seeing a lot. What is changing as well is you're seeing outbound CE investment and outbound Turkey investment. Alexander, you're working on a deal now with 25 countries of outbound investment.
Yeah, it's a natural result of the growth I was talking about as well. You have a lot of cash-rich companies who don't know what to do or where to invest with those funds. So, and you know, in some sectors, the opportunities are limited internally. So, I think last year we actually outbound investment increased 11-fold from out of Turkey.
Very interesting. And I think to your point about Eastern Europe, we're seeing again a resurgence of investment. There were some very big deals. Was it $2 billion invested by Jaguar Land Rover in its operations in Slovakia last year? So there's still inbound investment into these jurisdictions. And what really interesting trend is, the outbound investment. But conscious of time, I don't want to spend too much time on that, so I will jump off those sections. But I think we're going to hit probably one more issue that we have time for, which is relevant to everyone on this panel, which is, I think it's relevant for corporates generally, which is compliance, injury, bribery, corruption, etc. Which I was talking to one general counsel, and I'm a former in-house counsel myself, so I spent several years both in Europe and in the U.S. in-house and multinational. And I was chatting with one general counsel recently about how there's almost been an invasion of compliance specialists. You have these compliance departments and the compliance head, and I think it's driven by the reality and the need. And so we're going to talk a little bit about that. And actually, the IFIs are in part driving that because they insist on it in their deals. And so we have this compliance culture, which is coming, which very much impacts how deals get done and how we approach them. So maybe we'll just go down the table and each of us could give our thoughts on compliance and bribery and its relevance to both the deals you do and the markets you're in.
You're looking at me.
It's important.
Yeah, it's an important point. No, I think part of what the IFIs and DFIs do is try and drive the best practice environment, is to make sure that compliance is up to snuff. We all have to live with our own institutions and our own jurisdictions compliance, and part of our driver is to ensure that our investments comply with what we need to comply with, and try and come up to best practice. So we quite actively work with our investing companies to make sure that they understand the compliance landscape, certainly in terms of dealing with politically exposed people, which is a big one for the IFIs and DFIs. But much broader than that as well. So luckily, being based in Holland, I don't have to deal with the anti-bribery acts from the UK too often. So that's a bit of a relief. The Dutch are a little bit more lenient. Entrepreneurial, that's right. That's why we got that tagline. But it's still very alive to that issue. So.
Perhaps anecdotally, really, talking about one of the markets in CE where you've seen quite a big drive, or a bigger drive in terms of compliance and also anti-corruption, is Romania. I'm Romanian by origin, so this is a market very close to my heart that I'm following quite cllosely. And there's been a huge anti-corruption push in Romania over the past couple of years. The anti-corruption agency is being very active, and what they do is very public. And the conviction rate is incredible. So we're talking about over 90% conviction rate. And they've basically persecuted over 20 mayors. Prosecuted.
But some would say persecuted.
Prosecuted over 20 mayors, one prime minister, 2 other ministers, and about 1,000 other people, including judges,
It is amazing.
prosecutors,
It's across the board.
lawyers, actually. And probably these numbers are shocking for this audience, but it shows the scale of the corruption issue in some of these countries, and also how far a place like Romania has gone to try to eradicate it, really.
It's a sea change, and so
Yeah.
it's a huge risk issue for corporates, because if you're in your deal, you can get dragged into that investigation as well.
Yeah.
And, you know, I second what you're saying. I mean, the shift is massive, and I am 100% certain that would not be happening without the IFIs and the EU and the involvement and the push and the education, et cetera, et cetera. And maybe that's a good segue to Turkey as well, where we see an increasing amount of this issue becoming
Yes.
relevant.
But contrary to what Bella said, we're having problems getting to the prosecution stage. It's usually stopped somewhere before that, so we wouldn't mind some of that actually. But it's a very relevant issue. Maybe I approach it from a different angle. It's also a cultural issue as well, because you have these institutional investors coming into the country, or larger corporates who are subject to the Foreign Corrupt Practices Act or the UK Anti-Bribery Act in their jurisdictions. And when a Turkish family business sees this 5-page long anti-bribery clause in their contracts, then they take it personally and they say, well, what do you think I'm doing here? I'm not a crook. So what is this clause? And I think our roles as trusted counsel in that instance is to bridge that cultural gap and explain to the local party why this is actually not personal and this is required.
I think it really, I don't know if I can mention one of the deals that you worked on, but for GIC itself, involved on one of the biggest deals in Turkey that I was on there. But globalization of compliance. So you have a Singaporean sovereign wealth fund effectively applying as strict or stricter rules than you would find from a Western company. So it really is becoming very much a part of what we do on the deals, and we have to be conscious of it. Maybe Jamie,
Just a final word. We're very much doing similar things to Chris at FMO in terms of approving deals, and whenever we invest, we have to ask the underlying investing company to comply with always anti-money laundering. The same raft of documentation apply to all the funds that we're LPs in. But on top of that, we have quite an active public policy arm of EBRD, and that's active in all of our countries in the region. We're trying to have dialogues with local government to improve the laws on the ground, how they're enforced, judicial capacity. And a good example of that is Ukraine at the moment, where we have an anti-corruption initiative and an ombudsman. And that's really tied to our general strategy in Ukraine, because
I think we work with you on that.
yes, because unless the Ukrainian government reaches various milestones in terms of tackling anti-corruption, then we will provide more limited finance, etc. So that's our other lever to forcing changes.
Interesting issue. Maybe conscious of time, I wonder if anyone has questions or comments.
Everybody's hungry.
Yeah, I think it's lunchtime. Well, thank you everybody for attending. Hopefully that was useful, and if you have any questions, don't hesitate to catch us during the day. Thank you.